Hey everyone, welcome back to Corporate Decoder, the place where we try to unpack the mysteries of corporate filings. And guess what we have for you today? A filing that is a bit more about keeping the lights on and maybe a new direction for the company, so buckle up. Let's dive in. Alright, so what we have here is a company called NextNRG Incorporated or NextNRG Incorporated. This is a current report and 8K filing, which basically means something significant happened that the public needs to know about right away. The most important date here is the 18th of September 2025. This is when the main event of this filing took place. Now, NextNRG Incorporated is the company we are looking into. Think of them as the main character in this corporate drama. They are incorporated in Delaware, which is pretty common for companies in the United States. And their file number with the SEC is 001-40809. This is just a unique identifier for them. Their stock is traded on the NASDAQ capital market under the ticker symbol NXXT. When you see this ticker, you know you are looking at NextNRG Incorporated. NextNRG is also flagging itself as an emerging growth company. This basically means they are a younger company and are given some flexibility with certain reporting requirements. It suggests they might still be in a growth phase and not yet a mature giant. The core of this filing boils down to a very specific agreement they entered into, a stock purchase agreement. This sounds fancy, but it means they bought or sold something big related to their stock. And who did they make this deal with? It was with their very own Chief Executive Officer and Executive Chairman Michael D. Farkas. So this is a transaction involving the top boss. Here is the key detail. The company issued 1 million shares of its common stock to Michael Farkas. These shares are restricted, meaning they can't be immediately sold on the open market. These shares were valued at $1.67 each. Now this is where it gets interesting. Michael Farkas didn't actually pay with cash. Instead, he used debt. The company owed him money on several different promissory notes from earlier in the year. He essentially forgave or paid off this debt by accepting the new shares. So it was a debt for equity swap. The company is stating that this transaction was done without a public offering. They are relying on an exemption from registration, which means they did not have to go through the full public registration process for these shares. This section just reinforces the previous point. They sold equity securities shares that were not registered with the SEC. This is a common practice for private placements or transactions with insiders to avoid the complexities of public registration. And finally, typical for an 8K, they list the exhibits filed with this report. The most important exhibit here is Exhibit 10.1. This is the actual stock purchase agreement itself. This document contains all the nitty-gritty details of the deal between the company and its CEO. The report itself is signed off on the 19th of September 2025, just one day after the transaction took place. And who signed off on this report? None other than Michael Farkas himself in his capacity as Chief Executive Officer. This highlights the direct involvement of top leadership in this share issuance. So what does this all mean? NextNRG Incorporated used a debt for equity deal to issue a significant number of shares to its CEO. This could be a way to reduce the company's debt load by converting it into equity. For the CEO, it means he is increasing his stake in the company while settling outstanding debts. Now, looking at this from a broader perspective as investors or interested observers, we need to ask a few questions. Why would the company need to issue shares to its CEO this way? Is it a sign of financial distress where the company can't service its debt or raise capital elsewhere? Or is it a strategic move to align the interests of the CEO more closely with the company by having him hold more equity? Given that this is an 8K and not a detailed financial report like a 10Q or 10K, we don't have extensive financial tables here. However, the context provided the amount of debt discharged and the share price do give us some clues. The fact that the company owed its CEO $1.67 million also raises questions about the company's cash flow and its ability to borrow from external sources. The share price of $1.67 is also a key data point. If this price is significantly higher or lower than the current market price of the stock, it could indicate preferential treatment or a fair market valuation. Without more financial data, we are left to infer. In the world of corporate finance, such debt for equity swaps can be a double-edged sword. On one hand, it reduces debt that often carries interest payments. On the other hand, it dilutes the ownership of existing shareholders if new shares are issued. In this case, since the transaction is with the CEO, it raises questions about corporate governance and potential conflicts of interest. The company is also an emerging growth company. This often means it is in a high growth phase or perhaps a turnaround situation. Deals like this can be more common in earlier stage companies where capital is tight and leadership is deeply involved. What we would normally look for in a filing like this would be comparisons to previous periods. Are revenues growing? Are expenses managed? What is the overall debt to equity ratio? Since this is a very specific event filing, that information is not here. We have to assume that this transaction is intended to help the company move forward. The critical takeaway here is that the top leader of NextNRG Incorporated, Michael Farkas, took a significant amount of company debt and converted it into company stock. So instead of paying back the company owes him money, he now owns more of the company. This is a substantial transaction for a company of this potential size. We need to watch how this impacts the company's financial statements going forward, and whether other shareholders see this as positive or negative. Now, to give you my take on this filing directly shows the intricate relationship between a company's leadership and its financial health. The debt for equity swap is a powerful tool, but it begs the question why this method was chosen. If the company were in robust financial health, it might have been able to secure external financing or simply pay down the debt more conventionally. The fact that it chose to settle with the CEO through stock issuance suggests a need to manage cash or a strategic alignment that benefits the leader directly. The immediate risk here is potential dilution for existing shareholders. If the company's value doesn't increase proportionally with the new shares issued, then each existing share becomes worth a smaller piece of the pie. An opportunity here could be if this deleveraging strengthens the company's balance sheet, allowing it to pursue growth opportunities more effectively. However, without more financial data, it is hard to say if this is a sign of strength or a measure taken in response to financial pressure. My conclusion is that this is a significant event for NextNRG Incorporated. It reshuffles ownership and debt structure with the CEO at the center. It will be crucial to track the company's subsequent performance and financial disclosures to understand the true impact of this transaction on its long-term direction, and its ability to generate value for all its shareholders. Keep an eye on their next filings to see if this move pays off. Alright, that is our breakdown of NextNRG Incorporate's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.